Welcome back, guys. So in this particular session, what we will be discussing about is APM. Okay, so what we've been given is that so this is basically a question from SPR's exam kit, and then the question basically is about Tabasco. Tabasco is in retail industry. In the reporting of financial information, the directors have disclosed several alternative performance measures (APMs) other than those defined and specified under IFRS. Okay, not under IFRS, but APMs have disclosed the following APMs. Operating profit before extraordinary items is often used as headline measure of the group's performance and is based on operating profit before the impact of extraordinary items. Extraordinary items relate to certain costs or incomes which are excluded by virtue of their size and are deemed to be non-recurring. Tabasco has included restructuring costs and impairment losses in extraordinary items. Both items had appeared at similar accounts in the financial statement of the two previous years and were likely to occur in future years. Okay, so that has been going on. So what should we do? Advise the directors whether the above APMs would achieve fair presentation in financial statement. Okay, let's solve for this first of all. APM are not defined by International Financial Standard reporting standard and therefore may not be directly comparable with other companies' APMs, including those in the same industry. If the same category of material items recurs each year and in similar amounts, in this case, restructuring cost and impairment of asset value, impairment losses, then the reporting entity should consider whether excluding these amounts from underlying profit provides a faithful representation of economic performance, right? Under IFRS standard, items cannot be presented as extraordinary items, financial statement, or even in the notes. Thus, it may be confusing to users of AFMs to see this term used. Items such as restructuring cost or impairment loss should not be labeled as non-recurring where it is misleading. The entity make an adjustment for a charge or gain which they believe is appropriate, but they cannot describe such adjustments inaccurately. So in case of B, what we've been given is that operating free cash flow is calculated as cash generated from operations less purchase of property, purchase of own shares, and purchase of intangible assets. The directors have described these figures as representing the residual cash flow in the business, but have given no detail of its calculation. They have emphasized its importance to the success of the business. They have also shown free cash flow per share in bold next to earnings per share. Free cash flow per share as next to earnings per share in order to emphasize the entity's ability to turn its earnings into cash. Okay. So first of all, what they did was they deduct capital expenditure, right? Capital expenditure, yeah. Deduction of capital expenditure, purchase of own shares and purchase of intangible assets from cash flows from operating activities is acceptable because free cash flow does not have a uniform definition. Okay. Clear description of free cash flow and reconciliation showing how this measure is calculated should be disclosed so that users can draw conclusions about the usefulness of the APM, right? Entities should avoid misleading comments when describing APMs. Free cash flows cash flow does not normally represent the residual cash available as many entities have mandatory debt service requirement which are not normally deducted from the measure. It would also be misleading to show free cash flow per share in bold alongside earnings per share, as they are not comparable. So what has happened in third? EBITDR. Okay, so earnings before interest, taxes, depreciation, amortization, and rent. Okay, so as underlying uses EBITDA uses operating profit as underlying earnings. In the earnings release just prior to the financial year end, the directors disclosed that EBITDA had improved by 180 million because of cost savings associated with acquisition of an entity 6 months earlier. Okay, the directors discussed EBITDR at length, describing it as record performance, but did not disclose any comparable IFRS information, and there was no reconciliation to any IFRS measure. In the previous year, rent had been deducted from the earnings figure to arrive at this APM. Okay, so inconsistency. When an entity presents an APM, should present the most directly comparable measure calculated in accordance with IFRS standards with equal or greater performance, greater prominence. Okay, whether an APM is more prominent would depend on the facts and circumstances. In this case, the entity has omitted comparable information, calculated in accordance with IFRS standards from an earnings release, which includes APMs such as EBITDA, DAR, right? Additionally, the entity has emphasized the APM measure by describing it as a record performance. Without an equal, prominent description, any measure calculated in accordance with IFRS standards. Further, the entity has provided a discussion of the APM measure without a similar discussion and analysis of the IFRS standards measure. The entity has presented EBITDA as a performance measure such measures should be reconciled Profit or loss, profit for the year, as presented in the statement of other comprehensive income. Operating profit would not be considered best starting point as PBIT DAR makes adjustment for items which are not included in operating profit, such as tax and interest. Another thing they have done is the entity has changed He has changed the way it calculates the APM because it has treated rent differently. However, if an entity chooses to change an APM, the change should be explained and any comparatives restated. A change would not be appropriate only in exceptional circumstance where the new APM better achieves the same objectives, perhaps if there has been a change in strategy. The revised APM should be reliable and more relevant. Okay, so what do we have in number 4? The directors have not taken any tax effects into account when calculating the remaining APMs. The entity should provide income tax effects on its APMs depending on the nature of the measures. The entity should include current and deferred tax, deferred income tax expense, commensurate with the APM, and the APM should not be presented net of tax. As income taxes should be shown separately and explained. So what else do we have? So we need to go into question number 2, right? Okay. So what we will do is that we will do it in another part. That will be good as well. Let's see how many part is there. I think it's quite long. Yeah, it's quite long. Okay, let's see. Okay, so David is a car retailer who leases vehicles to customer under operating lease, and often sells the cars to third party when the lease ends. Okay, so that is also the business model. Okay, under operating, right? Net cash generated from operating activities for the year ended 31st August 2008 for the David Group is as follows. So this is that. So cash generated from operating activities, tax paid, pension benefits payments, interest paid, okay, share of associated, share of associates, share of profit, okay, and then cash flow from operating activities was calculated using indirect method. Okay, so net cash flows from investing activities should include interest received of 10 million and net capital expenditure of 46 million, excluding the business acquisition at number 3. There were some errors in presentation of statement of cash flow which could have an impact on the calculation of net cash generated from operating activities. So we need to adjust the operating activities for errors, right? We will do that. So the directors have provided the following information as regards any potential errors. Cars are treated as PPE when held under operating leases, and when they become available for sale, they are transferred to inventory at the carrying amount. In its statement of cash flow for the year ended 31st August 2008, cash flows from investing activities included cash inflows relating to disposal of cars, 30 million. Okay. So that was from car, right? So that amount is also included within this. Or it should be included, right? And then on 1st December 2007, so that means how many months ago? So we are preparing for 31st August 2008, right? So August, September, that means exactly 1 year ago, David purchased 25% interest in associate for cash. The associate reported a PBT of 16 million and paid a dividend of 4 million. Out of these profits in the year ended 31st August 2008, as can be seen in calculation above, the directors included a figure of 12 million, okay, associate share of profit. So out of that, okay, and then after that, as can be seen the figure of 12 million when calculating net cash generated from operating activities. The associate was correctly recorded at 23 million in the SOFP as at 31st August 2008. The profit for the year of 4 million was included in SOPL. No adjustment was made to David's share of associate profit when calculating cash generated from operating activities. Okay, so no adjustment for thingy, right? So this should be removed. And this will be 12 plus 4, right? So since it has not been deducted from cash flows, so we will deduct that 4 million as well. And this 16 million, not 16, 12 million will it's incorrectly included over there. So what we will do is that we will remove it. Okay. So David also acquired a digital mapping business during the year ended 31st August 2008. The SOFP showed a loss of 28 million in net cash inflows generated from operating activities as the effect of changes in foreign exchange rate arising on retranslation of this overseas subsidiary. The assets and liabilities of acquired subsidiary have been correctly included in the movement of cash flows during the year. So during the year to 31st August 2006, David made exceptional contribution to the pension plan assets of 33 million, but the statements of cash flows had not recorded the cash tax benefit of 6 million. Okay, so that's like a cash inflow, right? Okay. So what else is there? I'll have to find out the other thing as well. So additionally, David had capitalized the interest paid of 25 million to PPE 18 and inventory 7 million. Okay, so this should be also removed. And then David had defined operating free cash flows as net cash generated by operating activities as adjusted for net capital expenditure, purchase of associate and dividend received, interest received, and paid. Any exceptional items should be excluded from the calculation of free cash flows. So schedule that calculates the net cash generated from operating activities. A reconciliation from net cash generated by operating activities to operating cash flows. Explanations of adjustment made in part 1 and part 2. So first is schedule, right? Okay, let's prepare the schedule then. So our title will be adjustments of net cash generated from operating activities or errors in the statement. So first thing first is our draft net cash generated from operations in dollar 278 million. So we can close this one. 278 million, right? Yep, 278 million. And then what are the correcting entries? There is regarding disposal, right? Disposal of car is 30 million, right? So this will also be included. Cash inflows relating to car disposal, 30 million, right? Next thing it talks about is this one is associate, so we will talk about that later on. So first of all, let's solve this. Cash flow showed a loss of 28 million in net cash inflows generated from operating activities. So that means what we had done is we had reduced it, right? So we will add it back. Effects of changes in foreign exchange rate. So 28 million, and then this is tax credit, right? During the year, it made exceptional contribution to the pension plan of 33 million. Okay, so but the statement of cash flow had not recorded the cash tax benefit. Okay, so tax benefit recorded, not recorded. How much was it? 6 million, right? And then what else was there? So 5 number is in David had capitalized the interest payment of 25 million, right? Capitalized interest paid of 25 billion into PPE. Okay. Inventory 7 million. Okay, what shall we do is that reclassification. Of interest paid, right? 18 million. Capitalized, right? 25 million, out of which 18 million is from PPE related, right? So that is back. And then we need to talk about that fellow. Okay, associate, right? So associate has defined operating free cash flows as net cash generated by operating activities as adjusted for net capital expenditure, purchase of associate, dividend received, everything, right? Okay. So our net cash flow from okay, I have to look at this as well first of all. So adjustment for this. So first of all, I include this 4 million. So no adjustment was made for David's share of associates profit when calculating cash generated from the profit of 4 million was included in the SOPL, right? No adjustment was made for David's share of associates profit when calculating cash generated from operating activities. Why did it add 12? It should have subtracted that, right? Because it's already added in PBT. So we will have to subtract it, right? So directors include a figure of 2 million when calculating net cash generated from operating. Yep, they have done it. Okay. So what shall we do? Remove it. Associates profit correctly included 12 million, right? And next is about share of associates profit. Okay, fine. I was talking about this one. Okay. This one was profit for the 4 million was included in SOPL. Okay, so this 4 million should be reduced. Okay, non-cash item. 4 million should be deducted. This will give us the net cash flow from cash generated from operating activities, which will be $344 million. as per my calculation. I might be wrong as well. I'm in a bit of a hurry, that's why I'm doing it. Okay, so second thing we need to adjust for is we need to create a reconciliation for this free cash flow, right? Free cash flow reconciliation. Deviation. Okay, so let's take this figure down. In this, what we should add is net capital expenditure. How much is our capital expenditure? Capital expenditure. So adjusted for net capital expenditure, purchase of associate and dividend, and then interest received and paid. Okay. So what was our capital expenditure? Capital expenditure of 14 million. Investing included interest received of 10 million, right? Okay, so 46 million. Next adjustment that we should do is for purchase of associate and dividend received. Okay, so purchase of associate, we don't know this figure, and then dividend received from associate, we know this figure, it is 25% of the 4 million that we received, right? 4 million into 25%, 1 million, and that is also done. After that, interest received, yep, we have received interest of 10 million, right? Interest received, interest paid. How much did we receive? 10 million. And then after that, how much did we pay? Oh, it was up. Okay, so it's over here. Here, reclassification of 18 million. This should be subtracted, right? And then after that, what about pension deficit? $6 million deficit payment 33, right? Okay. Pension deficit payment. To exclude, okay. $27 million. So this should give us our free cash flow, which will basically be 44 plus 46 plus 1 plus 10. 47, 57, 57 minus 18 plus 27 plus this will give us 298 million. No, 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 no. We have missed something. Okay, so purchase of associate, right? Working note 1. Note 1, okay. Find out how much was the purchase price. So working note 1, purchase cost is not given, so this is what we are finding out. This will be the balancing figure. And share of profit, and then dividend paid, and we know the reported figure, right? Carrying amount. Carrying amount as at 31st August 20x8. So our carrying amount is dollar how much million? Mm-hmm. 23 million, right? 23 million. 23 million. Dividend paid was 1 million. Should be subtracted. Share of profit is dollar. So is it 4, right? Yeah. 4 million. That means 3. This should be 20. Okay. 20 million. Dollar 20 million. So this will give us a free cash flow of 298 million. Okay. So next thing that we will do is that explanation, right? Explanation of part A and part 2. Okay, let's explain that as well. So B1 to 3. Explanation of adjustment. First is purchase and sale of cars. David's presentation of cash flows from the sale of cars as being from investing activities is incorrect. As cash flows from are should be presented as cash flows from operating activities. Operating activities, which was how much was it? 30 million. IAS 16 property, plant and equipment it's that an entity which normally sells items of PPE which are held under or held for rental to others should transfer such assets to inventories at their carrying amount when they cease to be rented and become held for sale, right? That's the requirement. Subsequent proceeds from sale of such assets should be recognized as revenue in accordance with IFRS 15 and thus soon as cash flow from operating activities. Purchase of associate. Cash paid for the investment is $20 million and cash and dividend received is $1 million. In order to arrive at the correct figure for net cash generated from operating activities, the incorrect treatment of the profit for the year of associate eliminate. How much we eliminate? 12 million and 4 million will be thingy. Okay, we'll talk about that as well. $12 million, and the correct adjustment of $4 million shown in net cash generated by operating activities. Okay, so once this is also done, so let's talk about the foreign exchange. IFRS 7 states that unrealized profits, and losses arising from changes in foreign exchange rates are not cash flows. The amounts reported in the statement of cash flows included in either the effect of changes in foreign exchange rate the amounts presented or reported in cash flow included in errors reflecting the changes in foreign exchange rates arising on retranslation of its overseas operations due to this, right? As a consequence, cash generated from operating activities should be increased by $28 million, right? The cash has not gone out. All exchange differences relating the subsidiary are recorded in other comprehensive income on disposal of foreign operation the foreign operation, the gains or losses are reclassified to SOPL, right? In case of group. So other thing that we will talk about is pension. Pension payments. The pension payments are correctly included in operating cash flows. However, debit excludes them when calculating free cash flow. Free cash flow as the tax cash benefit has not been included net cash generated from operations activities will be adjusted for the 6 million and $27 million. How did we get that? 33 million minus 6 million will be excluded from the free cash flows. Calculation, okay. The next thing that we talk about is interest paid, right? Interest paid, which is capitalized as part of the cost of the should be treated as cash flow from investing activities. Interest paid and capitalized as part of inventory should be classified within operating activities. of the statement of cash flow, right? Thus, there should be a reclassification interest paid of $18 million from the activities to the investing section. Okay, so that's why we have transferred it, that's why we reduced it, and then we added it back in the other thing. Or it was added back over here and then it was paid from here. Okay, so this is basically how we answer this kind of question. If you have any questions until now, please do comment down below. I'll definitely answer it for you. After this we will see player 2, question number 27 of SPR's exam kit. So until then, bye bye.